Warren Buffett just announced his retirement from Berkshire Hathaway after 60 years, while sitting on a record $350 billion cash pile that's about to be deployed into four specific sectors. After 6 decades of generating 19.9% annual returns and transforming a failing textile company into a $1.2 trillion empire, Warren Buffett's retirement announcement has sent shockwaves through the investment world. However, what most investors are missing is the strategic positioning happening behind the scenes. A massive cash deployment strategy that reveals exactly where smart money should be flowing in 2025. Berkshire Hathaway's unprecedented $350 billion cash position isn't a sign of market pessimism. It's ammunition for one final wealth-building campaign. The Oracle of Omaha has spent decades perfecting his 4-pillar investment framework: understandable businesses, favorable long-term economics, trustworthy management, and reasonable valuations. Now, as he prepares to hand the reins to Greg Abel and Ajit Jain, Buffett is positioning his portfolio for the next generation of wealth creation. The timing couldn't be more critical. While September historically represents the worst-performing month for stocks, the current macro environment presents unique opportunities that align perfectly with Buffett's investment criteria. GDP growth remains solid, employment data shows resilience, and inflation appears contained, creating the ideal backdrop for selective stock picking in 4 specific sectors that are about to experience massive tailwinds. The first sector commanding Buffett's attention represents one of the most compelling investment themes of 2025: financial services positioned for deregulation. PayPal Holdings stands at the epicenter of this transformation, trading at what could be the most attractive valuation in its public company history. Currently sporting a market capitalization of $67 billion, PayPal has experienced significant pressure over the past 12 months, with shares declining 19%. This decline masks a fundamental shift occurring beneath the surface: the complete digitization of payment systems that surpassed cash transactions just years ago and continues accelerating. PayPal's competitive moat deepens with each passing quarter. The company processes $1.7 trillion in total payment volume annually, generating record operating margins of 18.2%. More importantly, their revenue growth trajectory remains robust, while operating profits continue climbing to unprecedented levels. The company's challenge isn't growth, it's monetizing their massive Venmo user base, a problem that successful tech companies face when they've achieved market dominance. From a valuation perspective, PayPal trades at just 13 times forward earnings, below their 3-year average of 14.1 times. The enterprise value to EBITDA multiple sits at 8.3, significantly lower than their 3-year average of 10.1. With earnings expected to grow at 12% compound annual growth rate, the stock presents a PEG ratio near 1.0, indicating fair value with significant upside potential. The catalyst driving this sector involves anticipated deregulation measures that could transform financial services profitability. When combined with the Federal Reserve's expected rate-cutting cycle, financial companies positioned in the digital payment space could experience multiple expansions alongside fundamental growth acceleration. The second investment avenue follows Buffett's preference for businesses with predictable cash flows and expanding market opportunities. KKR & Company represents the evolution of alternative asset management, controlling over $500 billion in assets under management across private equity, real estate, and infrastructure investments. KKR's business model exemplifies Buffett's favorite investment characteristics: recurring revenue streams, high barriers to entry, and expanding market opportunities. The company generates income through management fees and performance-based compensation, creating cash flow predictability that traditional asset managers cannot match. Currently trading at a market capitalization of $125 billion, KKR shares have experienced recent volatility, declining 6% year-to-date despite strong underlying fundamentals. This temporary disconnect creates an opportunity for patient investors willing to embrace Buffett's long-term perspective. The company's financial metrics reveal impressive growth trajectories. Net interest income continues climbing quarter over quarter, while revenue splits evenly between asset management and insurance operations. The insurance segment provides stable, recurring cash flows, while asset management delivers higher margin, performance-driven returns. From a valuation standpoint, KKR trades at 23.7 times forward earnings, elevated compared to their 5-year average of 17.7 times. However, this premium reflects the quality of their business model and growth prospects. When examining 2026 earnings projections, the forward multiple drops to 20.8 times, making current levels more attractive for long-term investors. The investment thesis centers on two key catalysts: declining interest rates that improve private equity exit valuations, and deregulation measures that could accelerate deal-making activity across alternative asset classes. Buffett's third recommended sector addresses one of the most critical infrastructure needs of the digital economy: cybersecurity. Zscaler represents the next generation of cloud-based security architecture, positioned to benefit from accelerating cyber threats and increasing enterprise digital transformation. With a market capitalization of $44 billion, Zscaler has demonstrated exceptional growth momentum, rising 45% over the past 12 months and 55% year-to-date. This performance reflects growing market recognition of the company's competitive advantages in zero-trust security architecture. The cybersecurity investment thesis rests on an undeniable reality. Cyber attacks continue increasing in frequency and sophistication, making security spending non-discretionary for enterprises. Unlike traditional IT expenses that can be delayed during economic uncertainty, cybersecurity represents a mission-critical infrastructure that companies cannot compromise. Zscaler's financial trajectory shows a company approaching profitability inflection points. While the company generated operating losses of $123 million over the past 12 months, it recently achieved positive EBITDA, a critical milestone that typically precedes accelerating profitability growth. This transition from investment phase to cash generation represents exactly the type of inflection point that creates wealth for patient investors. From a valuation perspective, Zscaler trades at 13.7 times enterprise value to sales, comparing favorably to cybersecurity peers. CrowdStrike trades at 20.1 times EV to sales, while Palo Alto Networks trades at 11.9 times. Considering Zscaler's superior revenue growth rate of over 20% compared to Palo Alto's expected 12%, the current valuation presents compelling relative value. The company's upcoming earnings report could serve as a catalyst for multiple expansion, particularly if management demonstrates continued progress towards sustained profitability while maintaining growth momentum. The fourth investment opportunity represents classic Buffett value investing: Lockheed Martin, trading near 52-week lows despite being positioned to benefit from unprecedented defense infrastructure spending. Currently sporting a market capitalization of $106 billion, Lockheed Martin shares have declined nearly 20% over the past 12 months and 5% year-to-date. This underperformance occurs despite global defense spending reaching historic levels and major infrastructure projects entering development phases. The disconnect between Lockheed's stock performance and defense spending reality creates an opportunity for contrarian investors. While competitors like RTX gained 39% and General Dynamics rose 25%, Lockheed has lagged significantly despite comparable business fundamentals and superior long-term project positioning. The company's financial metrics reveal challenges but also potential catalysts. Revenue growth has flattened in recent years, while EBITDA has decreased from previous peaks. Free cash flow generation has similarly declined, creating concerns about operational efficiency and project execution. However, these current challenges pale in comparison to the massive opportunity ahead: the Golden Dome Defense Project. This initiative, championed by the current administration, represents nearly $200 billion in spending over 3 years, expanding to over $800 billion across multiple decades. Lockheed Martin has already begun preparations for 2028 testing phases, positioning the company as a primary contractor for this transformational project. From a valuation perspective, Lockheed trades at 16.6 times forward earnings, essentially matching their historical averages of 16.3 times. The enterprise value to EBITDA ratio sits at 16.3, above the historical average of 12.6, suggesting current metrics reflect temporary operational challenges rather than permanent business deterioration. The investment thesis combines value investing principles with catalyst-driven upside. Current shareholders receive a 3% dividend yield while waiting for project momentum to accelerate, supported by over 20 consecutive years of dividend growth. If operational metrics improve alongside project development, the stock could deliver significant multiple expansion from current depressed levels. Implementing Buffett's four-stock strategy requires understanding position sizing and risk management principles that have guided Berkshire Hathaway's success. Rather than equal weighting these positions, investors should consider allocation based on conviction levels and risk-adjusted return potential. PayPal represents the highest conviction play, combining reasonable valuation with secular tailwinds and clear profitability metrics. A 35% allocation reflects the strength of digital payment trends and regulatory catalysts ahead. KKR merits a 25% allocation based on asset management quality and insurance operation stability. The business model provides downside protection through recurring revenue streams while offering upside through performance fees during market recoveries. Zscaler deserves a 25% allocation despite higher valuation multiples, reflecting the non-discretionary nature of cybersecurity spending and the company's approaching profitability inflection point. This position size acknowledges both growth potential and inherent volatility. Lockheed Martin rounds out the portfolio with a 15% allocation, representing classic value investing with dividend income and catalyst-driven upside. This smaller position size reflects current operational challenges while maintaining exposure to defense infrastructure spending. Successful implementation requires patience and strategic entry points rather than immediate full position deployment. Market volatility, particularly during September's historically weak seasonal pattern, could provide attractive entry opportunities across all four positions. For PayPal, target entry points around $70 per share align with technical support levels and provide a margin of safety relative to intrinsic value calculations. Option strategies such as selling put options can generate income while waiting for optimal entry prices. KKR presents opportunities around $135 per share, representing current market levels with potential for immediate deployment given the company's stable cash flows and growing asset base. Zscaler requires more careful timing given recent price appreciation. Entry points between $250 and $260 per share provide better risk-adjusted return profiles, though earnings results could create volatility-driven opportunities. Lockheed Martin offers the most immediate value at current levels, around $440 per share. However, waiting for further weakness could improve risk-adjusted returns given the ongoing operational challenges. Buffett's retirement announcement adds urgency to this investment approach. Greg Abel and Ajit Jain, Buffett's chosen successors, have spent decades learning his investment philosophy while bringing fresh perspectives to portfolio management. Abel's operational expertise with Berkshire Hathaway Energy provides a deep understanding of infrastructure investments directly applicable to both Lockheed Martin's defense projects and the broader financial services transformation. His capital allocation discipline ensures continuity with Buffett's patient, value-oriented approach. Jain's insurance operations experience creates natural synergy with alternative asset management companies like KKR, while his risk management expertise supports positions in emerging technology sectors like cybersecurity. This leadership transition doesn't represent disruption, it represents evolution. The same fundamental investment principles that generated 19.9% annual returns over 60 years remain intact, now applied by successors trained in Buffett's methodology but positioned to capitalize on 21st century opportunities. Current macroeconomic conditions favor this four-stock approach across multiple dimensions. Federal Reserve policy shifts toward rate cuts benefit financial services companies through improved lending margins and increased deal activity. Deregulation initiatives enhance profitability across financial services while reducing compliance costs. Cybersecurity spending remains recession-resistant, providing defensive characteristics during economic uncertainty while offering growth potential as digital transformation accelerates. Defense infrastructure represents government spending insulated from economic cycles while addressing long-term national security priorities. The combination creates portfolio diversification across growth rates, economic sensitivities, and market cycles, exactly the type of balanced approach that has characterized Berkshire Hathaway's success across multiple decades. Warren Buffett's retirement marks the end of an era, but it also signals the beginning of new opportunities for investors willing to apply his proven methodologies to today's market environment. These four stocks represent the intersection of Buffett's investment criteria with 2025's most compelling sector themes. The question isn't whether these businesses will create wealth, it's whether you'll have the patience and conviction to hold them through the inevitable volatility ahead. Buffett's 60-year track record proves that buying quality businesses at reasonable prices and holding for the long term remains the most reliable path to investment success. Which of these four opportunities aligns most closely with your investment objectives and risk tolerance? Share your analysis in the comments below and subscribe for continued coverage of the investment strategies that separate successful long-term investors from the crowd-chasing short-term market movements.